seminar. It's great. I know there's a number of people attending and listening to this seminar, so thanks for spending your lunchtime listening to these, I think, particularly important issues when it comes to capital gains tax. This whole area is very, very extensive, particularly in relation to property, and what we're going to cover today is obviously not exhaustive, because some of the topics alone I could probably speak, or Catherine could probably speak on half an hour just on the one topic. But what we wanted to do today is cover the main issues that we're seeing coming up in perhaps the last year or two. And it's based on an article we actually wrote about 6 to 12 months ago for the Your Property Investor magazine, identifying the key areas where there are issues in terms of capital gains. So you can see there, firstly, we're on our first slide, and some things, just really simple concepts to start with, is obviously capital gains is often misunderstood, particularly in relation to property investing. And simply, the first thing that is always a problem, and we come across this time and time again, is a capital gain as opposed to normal income is actually generated when on the date of exchange. And you can actually just put a real life example in that. If I go and sell one of my properties and I exchange on the 30th of June, so today is the 29th of June today, I should say, so I exchange a contract on the 29th of June, the capital gain will be calculated in this financial year, even if the property settles next financial year. So that's a really important thing to remember if you're actually taking notes in relation to this seminar. Obviously, the capital gain is also the difference between what an asset costs you and what you will receive when you dispose of it. And we're going to go into a lot more detail on that in the coming slides. And you pay tax on the capital gain. And even though the gain is referred to as capital gains, it's not considered a separate form of tax. So when you have a capital gain, it actually gets added to your normal income. Now, we know that there is a capital gains tax discount of 50% generally on property. So in short, your net capital gain would get added onto your existing income. This is really important because when you're thinking and planning of possibly selling a property, you would generally try to tax plan that gain in a year where you had minimal income. So really important point to consider when you want the exchange to occur. I suspect anyone trying to exchange contracts at the moment may want to put off a capital gain till next financial year by not exchanging till next week. Now, if I just go to our next slide, and we're talking investment properties, and I wanted to go for really a few key points in relation to this. And the first point you can see there is the depreciation claimed over the life of the property needs to be deducted from the cost base of the asset when calculating the capital gain. I use the word most there because there have been some changes for after budget night. A certain depreciation on second-hand properties are going to be bought. Won't be able to be claimed, so we wouldn't have to reduce that off our cost base. But for any properties pre-budget night, certainly we're going to be taking depreciation off the cost base of the property. So often people assume, and many accountants do this as well, and we've had to amend a number of tax returns over the years in relation to this. Often people assume that the cost base for capital gains tax is your purchase price plus your legals plus your stamp duties. But what is actually correct in terms of your cost base is your purchase price plus your additional capital expenditure. Legals and stamp duties would also be added, but then we would deduct the depreciation claimed. So the longer you own the property, the greater the reduction in the cost base for actually calculating the return. For just a really simple example would be if you bought a property for $400,000 and depreciated that property $50,000, your cost base for capital gains would be $350,000. Now, another interesting thing, and we're coming to the next slide, is the tax office actually require you to do an additional apportionment In practicality, this is something that probably isn't done, but it is required by the tax office, and what they actually require you to do is actually apportion your land and building value. So in terms of your valuation, we would have to get a separate valuation on your property upon the sale of that property between the land component and the building component, right? And if the building component of the property is actually higher than what your depreciated value, so you can see the building content of the property is often depreciated beyond its market value, i.e. that written down value is less than the market value of the building. There's what's called a balancing adjustment, and it's not on the capital account, so it becomes fully assessable. In simple terms, if you sold a building for $500,000 and you portioned the value between land and the building was worth $100,000 and the land was worth $400,000, but you depreciated the building down to $50,000, you would actually have a $50,000 balancing adjustment, which wouldn't be subject to the capital gains tax discount. It would only be the land component subject to the capital gains tax discount. So this is not good news for taxpayers. We always argue that the building component is equal to the written down value of the building, so our entire gain is normally subject to the 50% discount, but you should be aware this could be subject to a challenge from the tax office in the event of an audit. So something we've got to be very mindful of when we are calculating capital gains is we may, if we're unsure, have to look at commissioning a valuer to do an additional apportionment of the land and building. All right, I'm going to hand it over to Catherine Simons, who's going to be talking about principal place of residence.
Thank you, David. All right, as David mentioned, I'm going to be talking about some of the capital gains tax ramifications relating to your principal place of residence, one of our most popular topics. So initially, I'm just going to talk about the initial stages of purchase and what you do when you're moving into your property after purchase. So ideally, you should move into your principal place of residence as soon as possible after the purchase to make sure that you qualify for the full CGT exemption on that property. If you don't, so let's say the property is tenanted upon sale, then you won't qualify for the full exemption. And in that case, you will also not be able to use the market value rules or the 6-year absence rules, which we'll discuss shortly. So the ramifications of that is that if your property is rented initially and you don't move into it, there will be some capital gains tax upon the sale of that property. If you don't qualify for the full CGT exemption, the capital gain will need to be apportioned on a daily basis. So if you're not able to use your market value rule or your 6-year absence rule, we will have to use a daily apportionment method, and we'll run through an example about that shortly. All right, on to the next slide. So the 6-year absence rule, this is one of our most popular and most misunderstood rules in tax law. So we'll run through some of the major qualification items, and then we'll go through a little bit of an example about this too. So our 6-year absence rule can only be exercised when the taxpayer can demonstrate that they lived in the property immediately after purchase as their principal place of residence. This will allow the property owner to rent their property out for up to 6 years with no capital gains tax consequences. If the property is sold during that 6-year period, that you will have no capital gains tax ramifications. So if you've lived in the property for 2 years, you rent it out for 4 years, and you don't deem another place as your principal place of residence, that property can be fully capital gains tax free as long as you're not a foreign resident, because there were some budget changes about that recently. If the owner moves back into the property during the 6-year period, then you can reset and refresh that 6-year period and actually go ahead and rent the property out for another stint and potentially still have no capital gains tax consequences. So it's not a once-only style exemption. If the owner does not move in within the 6 years, the value is applied for capital gains tax purposes will be the value at the start of the 6-year period, but the principal place of residence exemption will still apply on a daily basis during the period of rental. And shortly we'll run through an example about that. To use this, you cannot have another principal place of residence at the same time. And just for the sake of clarity, between yourself and your spouse, you can only have one principal place of residence exemption applying to one property, or you can each elect to apply 50% principal place of residence exemption to two different properties, but that wouldn't be generally very tax effective. So over to our example. We've got an example here of a property which was purchased in 2001. And for the sake of clarity, all of the dates here are contract date, because as we know, our capital gains tax is based on contract date. So the property was purchased on the 1st of July 2001 at a price of $200,000. It was first rented on the 1st of July 2004 and then rented until sale. The value on the 1st of July 2004 was $400,000, and then the property was sold on the 1st of July 2012, so rented for a total of 8 years. The sale price in this example is $800,000. So we've got the total number of days rented being 2,923, and the total number of days that they will have to pay tax is 731, being the 2,923 less the 6 years that we're able to treat it as our principal place of residence, and that gives us that 731 days. So if we run through the calculation, and we've used round numbers here, we haven't worried about legal fees and sale commissions and those types of things, just for the sake of clarity. So we've got a sale price of $800,000. Our cost base is at market value at the first date of rental, or what we call the first income time, which is $400,000. So our taxable portion of that gain is 731 over the 2,192 days. That gives us a total capital gain of $133,394. We're then able to apply our general discount, giving us a taxable gain of $66,697. So although in this example they're not able to exercise the full principal place of residence exemption, there has been a good result overall by using these rules. All right, on to the next concept. The next concept we'll have a look at, and it plays in well with that example, is our daily apportionment method. So where the taxpayer has no entitlement to the market value method, we then use the daily apportionment method. So the daily apportionment rule allows us to, entitles the property owner to apportion the capital gain based on the number of days their property was their principal place of residence versus the number of days it was not. And we've got an example over on the next slide on how we calculate that daily apportionment method. It's a fairly simple calculation. So the part of the capital gain that is taxable is calculated by calculating first the total capital gain from the CGT event and multiplying that by the number of days it was your ownership period when the dwelling was not your main residence over the total number of days owned. So we'll run through an example below. Julie bought a house on 1 hectare of land under a contract that was settled on the 1st of July 2010, and it was rented out immediately. On the 1st of July 2014, she moved in and began to treat the residence as her principal place of residence. A contract for the sale of the house was signed on the 1st of July 2016 and settled on the 31st of August 2016. Julie made a capital gain of $100,000. As she is entitled to a partial exemption, Julie's taxable gain is calculated as follows. So we've got the $100,000 capital gain, and we've multiplied that by the number of days in the ownership period that the property wasn't her main residence, so that was 1,461, and then divided that by the total ownership days, which in this case was 2,254 days. So she has a total capital gain in this situation of $64,818. Now I'll pass back to David to discuss the 2 hectare rule.
Thanks, Catherine, and we're going to go on with this next slide. And the 2 hectare rule you may not have come across unless you have actually a principal place of residence, which is more than 2 hectares or basically 5 acres in the old measurements. So the thing about the 2 hectare rule is that basically allows a taxpayer to have an entire plot of land covered by your principal place of residence exemption if it's not more than 2 hectares, right? If it's over 2 hectares, then we've got some issues in terms of capital gains. And the event of a sale of the portion of the land over the 2 hectares will need to be excluded from the principal place of residence exemption. So if you're going out buying, a property in the country, it's 10 hectares, for example, then not all of that land can be covered by the principal place of residence exemption, right? The house can, the land up to 2 hectares can, but over that we're going to have to apportion that gain. You can see there, and there's a tax determination, it's 199967. So this tax determination came out in 1999, and you can see there on the slide, if you selected your area of land, if your selected area of land can be separately valued, you can calculate your capital gain on the remainder of the land by apportioning the capital proceeds and the cost base on the basis of the valuation. Okay, if you can't do that, and you can see that at the point, if your selected area of land cannot be separately valued, your capital gain on the remainder of the land may be calculated by apportioning the capital proceeds and the cost base on an area basis. So really, you can either separately value the land, or you have to do it on a portional basis, where really it's an apportionment of the capital proceeds. Now I'm just going to the next slide, and when you come to this, this is a worked example. Now you're not going to necessarily be able to grasp all of this first time, so I suggest after the seminar you actually work through this example. But you can see there, I'll bring out the main points. And remember I was talking about 10 hectares, so Fred owns a 10 hectare farming property and uses 4 hectares primarily for private and domestic use associated with the dwelling. In a way that's superfluous because of the 2-year hectare rule, so we've got to just keep that in mind. Fred sells his farm for $500,000, and included in that is $100,000 for the farmhouse, right? So the cost base for the entire farmhouse, you can see from his original purchase, is $300,000, including $80,000 for the farmhouse. So let me just reiterate: bought the property, $300,000, selling for $500,000. How much is actually attributable, given that the farmhouse was originally valued at $80,000. Now you can see there in that third point, therefore the cost base attributed to the 10 hectares of the land is $220,000. So you can see where we're going with this. We're evaluating we're looking at the original cost of the land, splitting the farmhouse up from the land to give us a cost base for the land, right? So Fred's nominal capital gain, if he didn't have any exemption, would just be $200,000. I think we'd all agree with that. Bought the property for $300,000, sold it for $500,000, right? However, because of the 2 hectare rule, we can actually look at 20% of that land value and apportion it to a principal place of residence exemption. So in this case, remembering the cost base of the land was $220,000, we can actually apportion $44,000 of that cost base to the principal place of residence. And with the capital proceeds on the 2 hectares, just the land portion is $80,000, and 2/10 of that proceeds attributable to the land can be attributed to the principal place of residence. Right, so the capital gain in respect of the 2 hectares is $36,000, being the $80,000 less the $40,000, and that's on the land only. And then the farmhouse, the gain's $20,000 because it's a portion of the farmhouse at $100,000 on the sale and $80,000 on the cost. Right, so simply what happens in this case is Fred can disregard the capital gains on the 2 hectares of the land, which is $36,000, and the profit on the sale of the farmhouse, and that's exempt under the main residence provisions. So you take that $56,000 off the $200,000 capital gain, and therefore your gross capital gain is only $144,000. And of course, with current laws at the moment, you'd be entitled to a 50% discount there. So have a look and work through that example after the webinar, because we can get soft copies of this for you. If you've got the idea of going and living on a farm somewhere in the country, thinking that the whole lot will be covered by the principal place of residence exemption, this is really relevant for you because there will be future capital gains, particularly if it's over 2 hectares per site. Right, on to our next topic, and we've got the part usage rules now. And this is really important. It's really relevant to a lot of our clients because a lot of our clients run small businesses from their own properties, and there may be a dedicated business part of that particular premises where they're actually operating a business from that premises. And this is quite an extensive area, but generally speaking, the taxpayer cannot generally utilise the CGT and small business exemptions to reduce the capital gain. And I am getting to some slides on the small business exemptions. But if you're running a small home business and we have to apportion a capital gain, we won't be able to use the small business exemptions. Look, a typical example of this might be a doctor's surgery operating from home. Or a dedicated proper home office. I'm not talking about something where you might claim a little bit of depreciation, and some very minor costs for an office. But if you've got that dedicated office, that you're using for your business, this is where we're going to have this issue in terms of capital gains. Now I'm going over to this next slide. You can see there, running a business as a part of a home, and we're trying to give as many worked examples as we can. You can see, and it's with Stephen. He bought his home under a contract, so it was settled in January 2000 and sold that property in November 16 was the contract date. Remember, that's the key date. And it was the main residence for his entire 17 years. So he's got a main residence exemption, but from the time he bought the property until 2008, right, he used a part of his home to operate his doctor's surgery, okay? So it wasn't for the full period. It was only actually for a part of that period, which is about 50% of the time he owned the property. And he only used the floor space. You can see there an example they represented he modified the roofs for that purpose. They were no longer suitable for private and domestic use, and they represented 25% of the floor area of the home. So Stephen then sold the property. He made a capital gain of 160. What do we do in terms of the actual tax? So what we need to do is look at the gross capital gain. Then we would multiply it by the floor area not used as the main residence exemption, and also apportion the period that the home was purely the principal place of residence and not the principal place of residence. So in our example, you've got a capital gain of 160,000, the percentage of the floor area 25%, and then the percentage of the period of ownership was 50%. So the actual taxable portion of the gain was only $20,000, remembering that's subject to a 50% discount, but you would not get the additional discounts for the small business exemptions, which we're going to touch base on very shortly. But before we do that, we're going on to holiday house. I think lots of us, if we don't have a holiday house in our property portfolio, we certainly want one. So this is very relevant in terms of us conducting our tax affairs. So a couple of things, and the tax office is a well-known fact. Every time they come out and talk about property and audits, they talk about holiday houses. Okay, so it's quite a large area. You could probably do a whole seminar on this, but the main things I wanted to focus on today is if you have a holiday house and you don't rent it out, you would generally not, if it's not available for rent, I should say, you won't be entitled to receive deductions. Taxpayers often forget, however, that if they're not claiming deductions, they can add these costs to the capital cost of their asset. And we've had people that have had 20 holiday houses for 20 years, and the holding costs of insurance, interest, council rates, water rates have been well in excess of $100,000. So it's really important, even if you're not trying to claim any deductions for your holiday house, and remembering it's got to be available for rent, you've got to be very careful. You probably have to apportion deductions anyway, but if you didn't rent the property, you would certainly keep all the documentation, right? Because we can add for capital gains tax when we don't claim a deduction these costs to the cost base of the asset. So just one point, it's a whole topic in itself, but really, really important if you've got a holiday house and you're not claiming deductions. Now I'm going on to renovation of properties because this gets very popular from time to time, and when you've been a property investor for a long time, you can often I suppose make the mistake of assuming that any properties that you're renovating and selling may be able to be subject to the 50% capital gains tax discount. And a couple of points I wanted to make is if with the taxpayer not entitled to the 50% discount, you'll be assessed on the full profit, right? So in order to actually get the 50% capital gains tax discount, it's really important that you're seen to be a long-term investor, not someone who's actually a builder employed in the building industry, or someone that has a regular history of buying property, refurbishing it and selling it. Right? In that case, the tax office would take a view that it's an isolated profit-making scheme, and then you will actually have to pay tax on the entire profit. Right, a couple of points on the screen there. Remember, there's a long history of case law rulings in relation to this, because some of these rulings go back to pre-capital gains tax days, where it was a big difference between a capital gain which was tax-free and a profit-making scheme which was assessable. Okay, so there's lots of history in relation to this. Also, the tax office has one thing up its sleeve. It has the benefit of hindsight on all your sale records. So our view and our advice to all our clients is, if you're going to buy a house, refurbish it and selling it, and you make a profit, then we just disclose all that as assessable income. We might structure it so it's in a lower income earner's name. There'll be things we can do to minimise the tax. But certainly if you've got a history of repetition in this area, particularly if you're in those high-risk categories such as builders, etc., then it's going to be really hard to argue. A few other things I'd point out too is the tax office can subpoena your bank to find out what you told your bank, so be really careful in that area. All right, I'm going to property users in the family business because we have lots of about 800 small business clients across our group, and lots of clients buy properties for their family business and use them, and it's a whole area in itself, and it's very complex. But I wanted to point out some extra things. Beside the CGT, a 50% discount, you can actually also have what's called an additional 50% deduction. It's called an active asset deduction, and there are rules associated with it. But providing you basically buy a business property and use it for business purposes more than 50% of the time in which you own the property, then you should be able to qualify for an additional 25% discount. This means that if you have a capital gain on a property used in business, effectively you'll only pay 25% on the tax, and you may be eligible as well to either put the remaining money into super, or if you're over 55 years old, you won't necessarily need to do that. Now, a couple of things. It's important to get advice regarding the eligibility of the active asset test, and also there are a number of limits on this. For example, there is a $6 million asset test and a $2 million turnover test. So you should be mindful of this. If you're turning over, you've got assets in excess of $6 million, excluding your house and superannuation, then you're probably not going to qualify for this last 50%. But if you're a small business and subject to the tax advice we'd have to give, if you're eligible, and the asset's active in the business more than 50% of its life, then there is a great opportunity to further reduce those tax benefits. So if you're in that position, please don't do anything until you get the right advice, but we just wanted to raise it as a potential way to save a little bit more tax. All right, we're coming up to inheritance of properties. You can see that we're going through the life cycle. Clients often say to me, well, I don't care what happens to my property because I'll be dead when they look after my estate affairs. But if you're wanting to plan to make sure your estate is minimising tax, first thing you need to do is you need to be aware of the history of an inherited property, because everything is not always that obvious, particularly if your parents, for example, rented that property out for some of its life. There may be issues, and Catherine spoke about, with the 6-year absence rule, market value rules, etc. So we've got to be very aware. So the first thing we should do is have a look at the history of the property, because often there's multiple changes in ownerships over a long period of time, which may make a pre-capital gains tax property a post-capital gains tax property. But putting that all aside, a principal place of residence, so if the property is only used as a principal place of residence, or it's a pre-capital gains tax property that is purchased before 19 September 1985, it'll be inherited at market values at the date of death, right? And family members do have 2 years to decide whether they're going to sell that property. No immediate CGT consequences. A couple of things though: a post-capital gains tax investment property will be inherited at the same cost base as the deceased. So think about a 400 grand property. It's been depreciated 200 grand. The cost base is only 200 grand. So lots of structuring required there, particularly if you're leaving properties jointly to children. As we know, they tend to fight, and there might be a deemed sale, which could result in a lot of capital gains. In fact, we've had recent situations where there's been hundreds of thousands of capital gains paid because of that very warning. Okay, we talked about the warning. If the property is being depreciated for many years, the cost base could be very low. That could be resulting in a large capital gain in the event of a sale. All right, well, look, I think we've come to the end of our seminar notes, and obviously we can always privately